All right, so it's a bit of a difficult backdrop in this environment. Where are we in our sort of our Dalio quadrants? We're still sort of in this environment where global growth is slowing and inflation is slowing. So what are the really primary asset classes and areas you should be looking at? Well, cash, number one. Actually, cash right now is not trash anymore. You can get 4.5 to 5% yield on T-bills and money market funds. So it's decent yield in cash. And then gold and bonds are kind of higher risk areas that generally tend to do well. So these are, main areas you're kind of looking for. You want to look for some technicals to confirm that these guys are moving. Gold is actually trending for higher. Bonds pretty much need to break out a little bit to do so better, but both have been doing relatively well. And of course, cash has really been kicking it. Now, if you want to learn more about themes and strategies associated with this, we've really went over those in a lot more detail in the High Yield Mastermind, and that's an e-course that you guys can think about getting if you want to get to the next level. When you look at portfolio strategy letter, in this contraction area, these are strategies that can tend to do well in that part of that Dalio quadrant system. Okay, so here we got diversified high yield, generally does okay. Long short is high risk but high reward. Uncorrelated, which is our mix of commodity strategies, gold, and macro themes. So these are kind of areas where you would look for ideas, find good technicals to follow through, and these are areas to look for. And as an example, our commodity strategy, which is all of the strategies, there's multiple ones in our uncorrelated section in PSL. These are up good, up 0.53% in the last month, up about 1% for 2023, after ending up nearly 10% in 2022, 12% in 2020, and 6% in 2021. So it's been very consistent, decent returns, and really pretty low drawdowns in the mix of uncorrelated commodity strategies that we have in PSL. And if you want something with a little more boost, a little more potential return, our own commodity strategies that use ETFs, this has been up, 760% over the last 225 months and has continued to do well in this backdrop. So those are ideas of areas, strategies. So we've looked at what asset classes generally you want to be looking at, what strategies in PSL tend to do well, and then give an example of some of the ones that have done for smooth performance, the uncorrelated commodities. Very good. You want a little more higher octane, our ETF strategy within that section. And then we're going to talk about and give you sort of a preview, some of the things that we really talk about and go into a lot more detail on in our High Yield Mastermind course, which goes into a number of different ways to build themes of what you're looking for, and then look at technicals and relative strength to tell you whether to start allocating to those themes. Is the market confirming them? And really, one of the ones that we really watch when we're in this type of environment that's negative for stocks is we watch pairs. And this is an example, the S&P over gold and gold over S&P. That's an example of macro pairs that we talk a lot about, how to trade in a high yield mastermind. What I want you to see really clearly after I go through this is that these periods, so we had this basically decade or more of secular decline when inflation flared last time, really starting about 1971, 1972, and it went all the way through 1980. What I want you to see was there was a bull market that went up 765% during that period when stocks were languishing. What was that? It was gold over the S&P pair. And in the secular decline off the 2000 peak, really probably the next biggest bear market that we've had 2008 to 9 as well. Both of those were really horrendous bear markets. During this secular peak, this gold over S&P pair went up ninefold, 900%. Now, wouldn't it help you to know that even though you're in a negative backdrop for one asset class, here's another area where you can get 900% plus gains during those bear markets. Let's take a look at the gold S&P. So this is the S&P gold. The inverse of that is gold S&P. You can create this. All you have to do to create this exact spread is buy an equal dollar amount of GLD and sell short against it an equal dollar amount of SPY. And you've created this exact spread. And let's take a look at the 70s environment. And what I want you to see, there's a really simple strategy that we're going to talk about. And that's just basically looking for double bottoms and consolidations that hold on the 50-week moving average. They don't close below the low that went below the 50-week moving average. And if they create a double bottom or a trading range and then break out, all you're doing is buying the spread. So in this case, you're buying, let's say 10% of your portfolio GLD and selling short 10% SPY against it. You've created this spread and putting a protective stop under the low of this consolidation and letting that ride until you get that close below a low that went below the 50-week moving average. What I want you to see is from 1972 to 74, this situation, if you bought this pair on this simple trading strategy, you got two signals. They were up 341% and 19R on the first trade and 215%. And because it was so low risk, 54R on this second trade. Now, if you're just risking 2% on these trades, you've made 74R, 150% on your money during this move at a time when the market was really collapsing. Okay, same thing for this gold S&P spread, doing the same thing. We go above that 50-week, we make a trading range, we break out. Here you had a gain of 2,700% and 30.6R. If you took all of these trades and just risked 2% from entry to open protected stop on the spread and let it ride until you got that break below the 50-day MA and then a close below that low, you could have tripled your money in this era when stock prices were languishing. Okay, here's a picture of what the Dow Jones was doing during that. It was going sideways in a whack-a-mole, up and down. So you want to look for things that are trending strongly, have good macro forces behind them, and find ways to get in with low risk and let things ride. Okay, here's how it did in the bear market coming off the 2000 highs. Had another nice move in the spread, went above the 50 MA, made a trading range. Here you got 168% gain on the money and an 89R trade. So you more than doubled your money just from the one trade. You got another one where you got 17R, and then you got some whipsaws. You didn't really get any trades, finally went above, had a trading range, and you got two more opportunities. Here you went down, you closed below you broke below the MA, but you never closed below that low. You made that double bottom and you got another trade. You had 13 and 5R trades. If you had taken all of these trades in just this one pair that basically the high yield mastermind teaches you how to find these themes, you could have tripled your money again in both of these situations with really minimal drawdowns, like less than 4%. That's phenomenal. So don't think because we're in a situation where, yeah, gosh, the outlook for the market's not that good, there's all these kinds of problems. Look for where there's a pair, where there's a theme that's starting to run, and find low risk ways to exploit it and ways to use trailing stops so you can let it run. So both the gold stock bull market episodes offer the ability to triple your money with extremely low drawdown risk just by trading double bottom consolidations off 50-week support. It's a great way to trade the gold S&P spread and the S&P and gold spread. So this idea of looking for trading pairs and macro themes like this is where we really focus on is the high yield mastermind class, which is now available as an e-course. And I think this can really help you find a lot more opportunities in an environment where everybody's thinking there's nothing to do, but really there are some great things to do. You just have to know where to look. Okay, so we continue to suspect that we're in a bull market, in a bear market, and it's possibly a secular bear market. We went up to the point in early February where, wow, if we broke those highs, we're going to have to change our scenario, but we did not break those highs. We turned back down clearly. We've gotten 80%, 90% down, lots of evidence, down volume days, lots of evidence of supply. Now we've kind of hit a temporary support level at the 50, at the December lows. And so and we really got oversold on an intermediate term basis. And we had substantial capitulation. We had 80%, multiple 80% down days and a 90% down day, and we're oversold. So we're likely to get some kind of a bounce. But so far we've got even coming off such extreme oversold, absolutely no signals of strong demand response. And how strong demand response we get may be dictated by what the Fed does tomorrow. Okay, so how big this rally is, and it's still likely to be a bear rally unless we get really significant demand response indications. Haven't really had those. So that's where we are. So we suspect that we're still in a bear market. We're going to get a temporary rally off of it. We don't know how big. Hopefully we'll get a correction over signal that we can sell short again if you've taken our mastermind in market timing. But in the meantime, we're more conservative and cautious. And when we break below and close below the December lows in the S&P, we have more certainty that there's more downside ahead. But in the meantime, gold is starting to try to break out. Bonds are starting to try to hit levels where if they break through, it's going to be important. And as we'll see, we'll talk about a number of other pairs that we get by looking for themes that we're really watching closely that can provide some great opportunities. Here's another one that we're looking at. This is the bond over the CRB pair. Now, the nice thing about the bond over CRB pair is it's a really good going into recession theme, right? Going into recession, you usually have some kind of an increase in bonds, can be pretty short if you're in a secular bear market like we are, but even if the bond side doesn't do that well, when you really start sliding clearly into recession, commodities dive. And so your short side does well. And what we can see in this pair is that it's been in a trading range for over 9 months, and it's starting to try to break out. How do you do this in ETFs? Very easy. Buy an equal dollar amount of TLT and sell short against it, an equal dollar amount of DBC, bonds over commodities. And you can see that that is basing right now, just like this is. And if we close clearly over this 475 level, that's an opportunity to get into the pair by buying TLT and selling short DBC against it that has some good upside room and some decent limited risk. It's another theme that we're watching. Now, oftentimes, as you get toward the end of tightening phases, and we're getting close to the end, even though we may not be over yet, so some of these markets are starting to move in ways that we really want to watch, but usually you get a decline in the dollar when that tightening phase gets near the end. And what I want you to see here in the dollar is that the dollar has some pretty clear 10-year cycles and has really since the 80s, right? Has a big high, declines, and it declines, and here's the low, but before you really take off, you make a secondary low. That was 10 years from the high, 10-year decline. Next, we rally, and it's a 10-year cycle to the next high. We decline again, and the secondary low is another 10-year cycle. And from that low, we've come 10 years and we've hit a resistance level. Now, we need to get some confirmation that this is happening, why a further breakdown in the dollar. But if we do get that further breakdown in the dollar, there's a chance that we're at 10-year cycle highs. That will be fantastic for gold and anti-dollar plays. So let's take a look at the dollar, which is really a critical part of this outlook. And you can see that we had a nice double top off of it and a big decline. And now we're in this really key consolidation that's at a really important support level. If we break down below this 100.5 area in the dollar index, this is a huge head and shoulder top. Okay, and it's coming at a time when we're expecting potential 10-year highs cyclically. And it's coming at a time where maybe monetary policy is setting up to shift to something that's going to be negative for the dollar. So there's a lot of things going for this. What we're really waiting for confirmation would be a close below this 100.5. We get that, now all of a sudden you got a lot of cylinders kicking into gear. You can short the dollar, you can buy the strongest currency against the dollar. Right now, the strongest currency against the dollar clearly is gold. And you can watch for plays and pairs that are associated with shorting the dollar or buying the strongest currency like gold. All right, we've got a big sort of banking crisis. We talked about in 5 pillars how really the banking system is not in stable footing, right? A free market banking system, banks are just intermediaries. You come to them with their money and they say, hey, do you want to buy part of a mortgage pool? Do you want to buy part of a commercial lending pool? All these things, but there's duration risk, and you decide how much of your money you want associated with that. Do you want it just sitting in gold like a Gringotts bank? What do you want to do? Do you want to load it in the T-bill market and just earn that kind of interest, which is totally liquid? In a free market, banks are more intermediaries, but in a fractional reserve fiat currency system, what they do is they take your deposits and they multiply them 10 or 20 times, and they loan out to mortgages and companies and all kinds of things. And so they can loan more money, but we have this problem. If enough people want their money, it's not there. And so what do? We put a sticker that says you're federally insured, and the federal government can print money to stand behind it. But realize, just like COVID, when they handed you those free checks, what those free checks were really is, here's your money, you're going to need it to pay for the inflation that we caused by giving you that money. And it's the same thing with this sticker FDIC insurance. There's not a big enough pool to insure all the deposits, not even remotely so. So really what you're banking on is, okay, the government will print a bunch of money and I'll get a bunch of worth a lot less money if there's a problem. So you want to realize that a fractional reserve banking system has runs on it historically, periodically. And that's what we're getting. We're getting some runs on the banks. Why are we getting runs on the banks? We've raised interest rates really. First of all, the regulation that we did after the GFC, right? All it really did is prevent that exact same thing from happening again. And it actually forced banks to do a lot of bond buying with their deposits. Okay, so banks took your deposits and they bought a bunch of bonds. And banks that were flooded with deposits in 1920 or 2021, they were flooded with deposits at a time when interest rates were artificially low, nearly zero. And so they bought bonds at the worst possible time. Now the Federal Reserve has to raise rates to fight inflation. All those bond portfolios are underwater, something in the range of 15 to 40%. Now, what the government does is it says to the banks, you don't have, if you put this in a portfolio that says you're going to hold them to maturity, you don't have to mark them to market. So nobody knows you've got the losses, and nobody knows how big the losses are. Okay, so we've got that situation, and then you had a bunch of banks that were in boom bust vehicles, right? Whether it's cyber currencies that collapsed about 70%, or whether it's in venture capital where the values have collapsed about 60%. All of those things have really had a big bust after a boom. And so what happened is that all the companies that got their venture funding, they would deposit it in SIVB Bank, but they need to draw on it. And they're basically using that money that they raised years ago to pay for all their everything. And so they started to draw down the deposits enough that what SIVB had to do is it had to actually sell off some of its bonds to pay the depositors. As soon as it sells off those bonds, everybody can see that it's got huge bond losses. And now they say, holy crap, how big are the losses? And they look at the whole portfolio, and then somebody on the internet or on social media says, hey, you got to get out of here. And very quickly everybody did. And so that forces them to have a liquidity crisis. It's different than the GFC. It's not a solvency crisis. No one is saying that the federal government's not going to pay those bonds, or that even the mortgagees that they have are in trouble and not going to pay those bonds, at least not yet. But it's a liquidity crisis. They have temporary losses on those. And when they declare them, everybody can see how big their losses are. And then you get a run on the bank. And so what the Fed has done is it's created a new 2008 sounding anagram is BTFP, which stands for Bank Term Funding Program. And what it does is it allows the smaller regional banks to go to the Fed and say, here are my bonds. And the Fed will anonymously, so that no one knows who it is that's borrowing, loan them the full par value of the bond, even though it's underwater by 20%. So that actually will eliminate the liquidity problem. We still have some problems for some banks, like FRC in California has a problem because it's loaded up with municipal bonds, and the Fed didn't put municipal bonds in the BTFP. So it's still got a liquidity problem that they're working on. But the Fed has somewhat close this gap, at least potentially. Now it's important to realize they've only drawn $12 billion on this facility so far, the regional banks, but there are around $620 billion in losses on bank portfolios that they're not marking to market because they're in their hold to maturity portfolios. So its potential, JP Morgan did an analysis that this facility, if everybody that has bond losses suddenly gets a run on their bank and has to go to this facility to get liquidity, it's conceivable that the Fed might have to put up $2 trillion to cover all these $620 billion worth of losses and hold those bonds. Unlikely that happens. But this was an attempt. It's not a solvency problem like we had in 2008, where everybody's realized that all these packaged together mortgages had a bunch of junk in them that we're never going to pay. That's not the situation. This is more of a liquidity crisis. But here's the impact. We've had draws at the discount window and at the BTFP. And here's what's happened to QT. All the QT since November has been wiped out in a week. Okay, so a lot of people now are saying, okay, well, the Fed's not cutting rates yet, but we can see that QE has started anew. Time to load up the bus and buy stocks again. But what I want you to understand is that in banking crises and going into recession, let's take a look at the last example we had. Here was the first rescue program in 2008. Here was the first TARP, which is nice four-letter word for bailing out institutes. The market fell another 40% for another year after these first programs were implemented. So yes, there might be bonds and then maybe gold would be moving more in accordance with this. But what I want you to understand is you had the balance sheet going up in 2008 and you still had problems because there were earnings recession and there was recession and there was further problems created by that. And we may have more tightening to come as well that will add to that. So it doesn't necessarily mean it's time to buy stocks, but we certainly start looking at bonds and gold more carefully. The reason that the Fed, the other thing to understand about that BTFP is that really think about the way that's designed. Anonymously, we give you full par on your bonds. What that's made to do is cure the liquidity crunch. And one of the reasons they want to cure the liquidity crunch is because they haven't really fought inflation well at all yet. So here, I want you to see this is the real Fed funds rate. That means the Fed funds rate minus CPI inflation. And what I want you to see is during the 70s, you got real Fed funds rate. In other words, Fed funds rate rose 5% above the inflation rate before it really started to turn down again. And that didn't even sustainably stop inflation on a multi-cycle basis. To do that, the Volcker had to raise the real Fed fund rate above 10% and hold it above 5% for many years. So the Fed, we're still at a negative real rate of Fed funds. So the Fed probably has more tightening to do, or at minimum, it's going to have to maybe tighten a little more and stand pat and let inflation come down and hold these levels high for a while if it wants to legitimately try to sustainably stop inflation. In the meantime, now that we've had a credit problem with some of the banks, banks are tightening credit much more stringently than they were even before. And they were already starting to tighten credit substantially in reaction to the inverted yield curve. The other thing I want you to see is that this is unit labor costs inverted. In other words, when unit labor costs go up, this curve is going down. And what I want you to see is past big declines so in other words, rises in unit labor costs have led to problems for S&P profit margins, right? Labor costs go up, profit margins come down. Labor costs go up, profit margins come down. This is one of the steepest increases in labor costs that we've ever had. Profit margins have started to come down, but here's the thing. Analysts project that they'll go up and make new highs. They're projecting earnings and margins to continue to go up, even when cost pressures are exploding. It's not very likely. More likely, we have an earnings recession coming. We've already seen earnings growth flatten and consensus analysts flatten. And as we get more concerns about recession, that's when consensus earnings begin to decline and when you get the big decline in stock prices. The other thing I think is important to realize is if the Fed could point to a number of things in the economy and say, hey, this is getting to be a disaster. If we don't loosen, it's going to be a crash. It's going to be a real potential depression. The Fed can't really make that argument very well right now. And I wanted you to see a couple reasons. This is the high yield spread. High yield spreads are going up, and when they go up, it's not very good for stocks, but they're not up at recessionary levels yet. This is the 10 spread. The 10 spread is what's the difference between what banks are willing to loan to themselves and the overnight rate, the LIBOR, versus a T-bill rate. Well, when you start going into recession, you pop up above 150 historically. We're not anywhere close to doing that. So there's not really a lot of evidence that the bank liquidity problem for regional banks has turned into something that markets think is a real systemic level crisis yet. Okay, the other thing I want you to see, We bounced. Here was our original bear rally target. When we started this October bear rally, we talked about it in either December or February. We went to early February. We got our internals saying, okay, this has got to turn down, but it did turn down, and it did turn down sharply. Now on an hourly chart, we've hit really important HVN at these D lows. We're likely to get a bounce, but it's likely to be a bear rally unless we get really, really strong symptoms of demand. It's a bear rally, and you're kind of looking at it as, okay, we get a correction over signal. We're going to see if we get a bunch of resistance there and look to sell it short again. Okay, and I want you to see, comparing this to 74 in the NASDAQ, they are very good analog, and you could have a long way to go. So further evidence of recession, continued sticky inflation above 3%, evidence of declining consumption, continued Fed tightening, further credit tightening, which we're getting now big time from the banking problems, earnings recession, declines in actual buyback flows. So buybacks that are starting to deteriorate because now companies look at the interest rate they could get by just holding cash, and wow, it's a bit different mathematics. And before, they were able to borrow to fund the buybacks at nearly zero. Now they have to borrow at 4.5%, 5%. So buybacks, which, if you'll remember, $5.1 trillion worth of buybacks was the main source of demand that fueled the 2009 to 2021 bull market. That's potentially starting to dry up. Gold is breaking through some resistance and kind of playing around here. And what we want to understand is that just at the very last bit of hiking cycles is often when gold begins to turn up. Here's gold's turning up. We're not at the end of the hiking cycle, but we're getting near it, right? We get near the end of the hiking cycle, gold begins to turn up. And so we're coming to that period, and gold is starting to break through resistance. If it can continue to do that, particularly if we can get through this these all-time highs at around 2080 on gold, that's going to be a cup and handle breakout, and that will really launch a move into the 3000s projected. So gold's is starting to look really good. It's holding up very well. It's actually rising when the market's falling, and it's starting to pick up some good volume traction. And we've got some macro reasons to be looking for gold to do relatively well as long as it holds above this big HVN just over 167 or so. We've talked about selling short junk as a way to play the likely increase in yield spreads. And right now, junk needs to close below 89 to really prove the thesis. But certainly we get back above in this 92 resistance area, you can start to sell it with protective stops above here and add to it if you close below 89. So that's a decent short to consider. And we'll look at more aggressive stock shorts and other correlated asset classes. We get it closed by the S&P below the D slows ahead that will confirm more clearly the thesis that the bear market continues. Opposing that, we want to watch out for China reopening, but we want to do that by having the markets reflect that. We would really, for the Chinese reopening to show that it's really starting to even overwhelm the forces of recession in the West and the problems that we have with Western growth slowing. We want FXI to break out of this head and shoulder, huge head and shoulder above 34.1. We'd like copper to at least close above 4.3, and we'd like oil to break out above 85. Oil's broken down. Let's see if it holds or if it closes back above 70. But it is starting to look like with bonds and oil, they need to follow through. But if they follow through, they're starting to discount recession and say that recession is going to overwhelm anything that China does. We talked about in Reed's report, if you've taken the Market Timing Mastermind, which is available as an e-course, had this fantastic trade that we talked about a day later in the Reeds report, a month or so back in early February, where you got a pattern that we look for off that resistance level that we've been talking about for a long time. We're able to sell it short. And when you get a 2R, you take half profits and you buy a call that's just with a strike price somewhere between your open protective stop and your entry, and that makes sure that you can never lose on the position. This since then has grown into a 5R profit because the market has declined, and basically every time the SPY moves down another 5 points, you've got another R in this trade. If you had traded all of the correction over signals you find, which you learn how to find in the market timing mastermind, you would be up over 50R right now. And if taking 2% per trade, that's doubling your money in this bear market. And if the market moves lower, you're leveraged to the downside. We've now moved our trailing stops by moving our call strikes down. So we've got a locked in profit of more than 35R no matter what happens. But if the market continues to move lower, you're heavily leveraged and can make much more money than you've made so far. I think it's one of the best strategies for a bear market that you can really focus on in the market timing mastermind. The other thing to realize is as the recession grows and the market drops further, it's going to set up even better opportunities in some of our distressed asset strategies like WAM dividend and others that Chuck's going to talk to you about as well.